Office rents are falling. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article from realestate.com.au or commercialrealestate.com.au, originally from the Fin Review, discussing disruptions in demand sent office rents lower. Now recently we looked at a few other things. We had this article here from, again, the Fin Review, looking at Growth Point, where one thing that really jumped out, they were able to, and I'll see down here, collect 97% of their rent. Now, Growth Point is a real estate investment trust with a significant holding in commercial properties. If we jump over to here, we can see their shares are now at $3.41, and they've got a 5.51 dividend yield. If we go out to Feb, they're over at $4.30, and they took a bit of a hit. But they're doing okay at the moment. They're slowly tracking up, and they predict that, well, due to the economic changes, more people will move to their assets, which are on the fringes of the sector, of the cities. Another company we have are Dexus. They're also a real estate investment trust, and they're similar to Growth Point, playing in similar markets. They're at $8.71. Their dividend is 5.77. If we zoom out to a year, you can see they were at $13.41. Look at the market caps. Growth Point is at $2.63 billion. Dexus is at $9.5 billion. Dexus is a name I'm much more familiar with just with my day-to-day business. But let's have a look also. We'll jump here, go to the Property Council of Australia, their data room, and you can see here we've got some office information just to get a bit of an understanding about what we're looking at in this report. So we can see the stock levels in the different cities. We can look at the vacancy rates, and this is the chart I really love because it quite clearly shows the last recession. It went from 5% over 20% in Australia in office vacancy rates. You can see that for all the different cities: Sydney, Melbourne, Brisbane, and Canberra. Really, it's a bit delayed. The impact of the recession, one could argue, on commercial tenancies is delayed in Canberra, at least on this data. Now, we're seeing declines in residential real estate. In property investors are increasing their listings, particularly in the apartment stock. Now, are we going to see this as well in commercial? And will it only be in the great? So a Growth Point, right? Let's put the theory crafting hat on. A Growth Point, right? Will it be in the better quality stock in the CBD, in the city? Maybe people will move their offices out into the suburbs or around the city, or the outer ring. Maybe going from an AA stock to a B stock. Dropping down. If you have people working from home and then you need to come in for maybe occasionally things or to use resources, do you need a premises right in the city? Or could you have much less floor area? Could you significantly reduce your floor area? Perhaps. So it's definitely an interesting market to keep an eye on. Quite an important one. I don't think it'll get as much attention in the media as residential property, just because of how many of us are invested in residential. Everyone is in Australia. We're all obsessed with it. So let's have a look at this. So rents for prime office space, so this is the top, the real high quality, in Sydney CBD could fall by 9% by the middle of next year, and by even more in Melbourne, as weakening demand pushed vacancies higher, according to industry analysts. So they're predicting bigger falls. 9%, that's going to affect your hits. But this is, as we're saying, this is the prime part of the sector, the really high end of the property. And here in Brisbane, I know we've worked with clients where they've had to upgrade their commercial towers, add new facilities just to attract tenants, because it's a very competitive market, particularly if you're that step down from the prime stuff, particularly in that B category. The disruption in demand will put a brake on new supply as major office projects take longer to establish sufficient pre-commitments to launch construction, according to Collier's international report. That impact on supply should in turn allow the market in CBD office space to rebalance itself by 2024. So, a takeaway for that, for all of us in the construction game, for all of the consultants working in this game, is that there would be an increase in building work for commercial in the properties. A decrease. It might be a increase in 2024, but there's going to be a decrease coming into that. What do you think? Are you in the office refurb game, everyone? What's your pipeline? looking like? More immediately, though, net effective rents, which take into account the value of incentives, are headed down. And incentives, for those of you that don't know, that's where if you're going into a tenancy, they'll give you some cash up front, pay for your fit out, or do something, give you a free period of rent. When we went into our little retail space, they gave us $2,500, which paid for all of our flooring as an incentive. We're going to start seeing that happen in residential investment. I bet you we'll start to see incentives become part of the, to get someone to take your investment property, because it adds, particularly in commercial, it adds value. Commercial and retail, it adds value to the asset, the occupancy rates that you have. That's a very important number. Premium rents could fall by 8.9% to $734 per square meter annually in the CBD and by June next year, or by 10.7% to $530 in Melbourne. Vacancy rates could rise above 9% in both cities by then. Among the other cities, Adelaide is worst hit with a forecast 23.5% fall in rents to $163. Just look at these differences in rents, everyone. These square meter costs. Now with remote working, why wouldn't you set up an office in Adelaide? Why wouldn't you set up an office in Adelaide? Have all your staff working there. They'll have cheaper housing. Sure, it's Adelaide. They won't have access to timber, but still. Those forecasts are base case expectations, according to Anneka Thompson, a consulting researcher for the report, which generated several forecast scenarios to take into account the uncertainty of the situation. We've never had to forecast in an environment like this before, she said. And we're seeing that more and more. Even the RBA, with their data, with their predictions. It's been so long since we've had a recession here in Australia. How are we going to respond? White-collar employment underpins office demand. Corporate tenants have already been giving up sublease space in near record amounts. The rapid embrace of working from home during the lockdown and its long-term implication creates further uncertainty for the outlook. Border closures will hit the market hard because new migrants have been a major driver of demand for office space and for the business, services, education, finance and IT sectors, Ms. Thompson said. It has never been more challenging to understand what employment and therefore demand conditions will be this year or next. The report's base case forecasts are relatively conservative. Goldman Sachs expects vacancy in the Sydney CBD to peak about 13% by the end of 2022, when net effective rents will fall by 40%. Wow. We'll have to look at that one in another video. I've got another article I want to look at just with Pinterest paying a fortune to get out of their commercial lease. So, yeah, WeWork isn't looking like such a brilliant idea now, is it? Peak vacancy, also close to 13%, will hit the Melbourne CBD a year earlier, with net effective rents to drop by 42%. Morgan Stanley tips rents to fall as much as 20% in Sydney and Melbourne. The country's largest owner of office towers, Dexus, expects rising incentives could put net effective rents lower by 10% or to 20%. We're expecting rents to be under pressure. Businesses are not in long-term decision-making mode at the moment, Chief Executive Darren Steinberg said last week. The lag between disruption in demand and its impact on supply will play over the next 4 years, according to Simon Hunt, Collier's Managing Director for Office Leasing, allowing office markets to find a balance underpinned by the fiscal discipline of lease lenders in backing new development. Post-COVID, we expect that this discipline will get even tighter, and a number of projects will need high pre-commitment hurdles to get built. So we're going to see a hit to the commercial sector, everyone. We're definitely going to see it. Well, I'll have to look through some of these other reports in another video. But what's your pipeline? Are you in the commercial game? See, this is the thing. Building approvals for residential has just taken a hit. It's taken a big hit. And often people will try and jump into commercial, but commercial's taking a hit as well. And here's another thing. If property does take a big hit, just residential, if there's a big 40% hit, how many people are going to be building when you could just buy something pre-existing? What's that going to do to the demand for construction? We'll have to see, everyone. We'll have to see. Let me know your thoughts and opinions in the comments down below. Are you involved in the commercial construction or fit-out sector? How's your pipeline going? Do you have enough work at the moment? What's the next 3, 6 to 9 months? That's the big issue. Now you might be busy. It's all the stimulus. It's all the artificial allowing people to trade while insolvent. But that could all disappear in March. As always, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care. Have a great day. I'll see you all next time.